Hey guys, welcome back to So Ready Podcast. Today I have Josh Greenbaum, and I'm very excited to have him. He's the founder of CFO Minded, and I want to learn a little bit more about the impact he's currently making on his clients, how he's able to help people become so ready, and the things that people need to know in order to build a profitable business. So thank you, Josh.
Thank you for having me.
Yes, yes. So if you could give me a quick walkthrough, what do you guys do or working on at CFO Minded?
We're doing a couple things. From a service and deliverable standpoint, we do your traditional bookkeeping all the way up to CFO services. And the CFO services to me is where it gets fun and interesting. And we'll touch on areas that we'll explore today. And it really helps, business owners get clear on their finances. And it could be from all sides of launching a business to figuring out their own strategy and sort of growth all the way through to exit. And we help a wonderful variety of clients in a bunch of industries and happy to do the work that we do.
Okay. Perfect. You mentioned on your website now, Josh, that you can help someone 10x your business and exit. How do you do that?
It's really getting clear on the business model. To me, we start always at the fundamentals. It's looking at the unit economics of the product or the service you're selling and ensuring that that's really dialed in and turning out a good contribution margin and that you're having a healthy business model with that speaking to work with. And from there, it's really understanding the components that drive your business. If it's looking at your marketing and your advertising revenue and how can we kind of put gasoline on the fire and start to really grow that top line. Or it could be even re-examining pricing and ensuring that your pricing's in the right place. And often it could actually be stripping out some elements of business that where you have lost leaders or kind of unprofitable elements of your business that can reduce the noise, so to say, and really help focus and scale.
Yeah. Yeah, yeah. And so let's talk a little bit more about a few things you spoke about. Hey, like you spoke about the pricing of the offer of the product and how this affects bottom line. And so how often are you walking into where a company may be undercharging or overcharging based off of, what they can actually afford and their business model?
So there's really two ways that I would address that. Let's start from a service company, and then I want to talk about a product company, so that we're kind of addressing different elements of what a listener might be thinking about this from the perspective of. From a service offering, in both cases, you have your element of commodity versus luxury, and where you price within the market, and to really think about the value that you're driving and how much time as a professional that you're giving to clients and the bandwidth, and to think about not only perhaps face time with the client, but there might be prep time and follow-up time that a client may not directly see, and to take that all into full consideration and the impact that you're creating on a client's business, to really think about what is that value and what is the appropriate price point for you to fully deliver what you need to do.
Yeah.
On the product side, sometimes, it's kind of a same exercise from two angles, whereas you might have the opportunity to look at your cost structure and to understand, in particular in recent years with tariffs, rising prices, freight, storage, all these elements that kind of build into your product cost that could be eroding your contribution margin, your profitability on that product, and to constantly examine that on a regular basis so that you're assessing that price and ensuring that you're driving the profitability that you want. And alternatively, kind of top down, would be to go out and look at the market and what are people selling at and where are you priced low in the market, average of the market, top of the market, and there could be opportunity within there to examine your pricing as well.
Yeah, yeah. Okay, okay. And so to kind of dive deep on the service side first, you mentioned that you have to consider how much time is actually taking, how much face time are you spending with each one of these customers, and how would you help someone better quantify that? Like, are you saying, hey, track the amount of hours you're spending per customer, and then are you cross validating that with how much they're charging, and then what if they have team members? Like, how are you helping these companies, these service based companies, quantify that metric?
Yeah, there's definitely the element that after time you start to understand the nature of the business and maybe a tech stack that you're utilizing that can bring efficiency. And outside of that, it's an element of thinking about, yes, sort of tracking your time and understanding how much you're willing to commit or need to commit to delivering on a project or on a recurring basis if it's a retainer type client. And from that, to build the structure around if it's proactively setting meeting times so that you're not in a reactive mode with clients calling and keeping you on your heels and taking up that time. And then
Yeah.
there's also the element of thinking about your own capacity, just as a human being in life, of perhaps there's time that you want to take off during the year. You want to take summer off or the holidays off. And again, to think within your pricing, it's easy for people to get into business and think, I want to make X dollars and I'm going to divide by 12 months and I'm going to divide by 4 weeks and work your way down to an hourly rate or a retainer. But it's really important to think about, like, what do you want your year to look like? And perhaps you're dividing by 11 or dividing by 12 months to ensure time off and protecting your own capacity.
Yeah, so even the way that you're calculating how much you wanna make on that annual year, you get to decide what you want that fiscal year to look like, whether it's over 12 months or you decide it's 10, and that's how you're gonna calculate your finances in order to meet metrics and still give yourself time to live life.
Completely. And the one thing that I always try to impress upon small shops in particular, but it's a true fact for a service company of any size, is again, it's easy to go in business and we'll use just the number of $100,000 and you want to start a consulting business and make $100,000. It's really easy to aim your pricing at that level. And the thing about it is a healthy business would have a 50% contribution margin, which would mean your revenue minus your cost of labor in this case. And that healthy business should be at 200,000, so you can pay yourself 100,000 and there's 100,000 left over, which allows for all the other expenses within a business. So to caution people from getting too locked in on the number on their head and to understand that you might want to double that, in fact.
Yeah, I love the double it metric.
Yeah.
That's actually something I live by. It's like if you have a goal, two x it. That even heightens your chance of hitting the first goal anyways.
And if you want to grow, if you're
Mhm.
going from a sole practitioner and you want to grow and add a second person, it's very hard to grow from that place of revenue that's covering yourself to growing, expanding to a place where you can afford another person. And so by living by that 2x rule, you are now also affording your self growth opportunity in the future as well.
Yeah, yeah, and to shift gears here to the product side, right? When someone has a product-based business, bookkeeping is a little bit different as you scale because as you scale on a product-based business, the cost of goods decrease, the amount that you have to spend on the cost of goods.
Correct.
And there's obviously other factors that would increase, right? Maybe the amount of money that you're spending on team, the amount of capital that you're spending on just orchestration of the overall business. How are you helping, these product-based businesses with this balancing act?
So you spoke to something really interesting, and I'm glad you touched on it. Is as you're growing, that your product costs can go down, which is exceeding. There's typically a minimum order quantity. So if you're to buy widgets and you're placing your very first order, that factory may have a minimum of 1,000 units that you need to buy. And as you scale and maybe can buy 10,000 at a time, you're going to get a lower price for the volume. So in that growth, what that also does is it ties up capital in your inventory. And so to ensure that you're properly planning for that through cash flow management, looking at seasonality, thinking about trends, are you, buying from overseas and what's that travel time for it to get to you? And to take all those things into consideration and just truly understand not just profitability, and now you're adding this layer of cash flow management. And there are things within that you can do to mitigate that and help with cash flow. But those are the considerations that you really want to explore.
Yeah. Okay. Okay. And so when you're evaluating a business, which financial metrics are you considering first?
To me, again, it goes back to unit economics. So that we're really ensuring that your core business, your revenue minus your cost of goods is tight and understood because that's your biggest leverage point. From there, I really like to dial into marketing spend and in particular anything that's going to drive revenue. So people often know customer acquisition cost. And so to really understand, is that converting at an appropriate level that is also creating profitability and converting enough revenue? And then lastly would be looking at your overhead and really ensuring that there's no fat within your overhead. What are people doing? And not that everything should be a cost-cutting lens, but think more so of an optimized lens and to understand just that dependability and ability to manage your overheads for that consistency month over month.
Yeah. Yeah, agreed, agreed. Do you know, 'cause, you get asked this all the time, and, like, I have to ask my clients these things all the time. You spit out a bunch of metrics, a bunch of different KPIs, and, these acronyms that, a founder just doesn't remember what they all are, right? But what numbers do you think every founder should know just off the top of their head?
It's interesting because some clients are motivated by top line, some are motivated by bottom line, and
Uh-huh.
some don't want to see the numbers at all. And for me, it's really understanding I guess I would say the psychology of each client, each person to understand their relationship and fundamental kind of understanding of financial statements and numbers and to guide them on for whatever that motivator is. My job is to help protect that bottom line ultimately. So I like to ensure that I'm explaining why we're pricing things a certain way so that they understand if they want to go off in their creative mind and the strategic planning and launching new products or services, that they're understanding how I think about it to give them that element of that financial lens, going back to how we were talking about 2xing your service. And for them to just understand that, I now feel confident that they're protected in the elementary portion of that
Eh,
business that is the most impactful.
yep, yep. Okay, okay, just understanding their bottom line.
100%.
Got it. And how are you even determining whether a business has, like, a spending problem or a revenue problem?
That's a really great question. I think the founder owner's ability to have interest in their own business, and I'll explain that, or again, almost the fluency that they have within the different levers that they're pulling. So in my first comment is I think some owners get burnt out over time. I've had clients where they're 20 years into business and they just kind of want to check out and they still want a salary. And so now they've hired to replace themselves and to really work through it with them and understand sort of where their needs are, where their energy is, where their motivation is, and what is the team that needs to support that so that we can re-engineer financials and talk from that perspective. And on the other end of it, perhaps an example of, I'll say air quotes, complexity of introducing debt into an equation, introducing things that can hide cash flow or have an impact on cash flow that they may not think about. Whereas, let's say, product company, they get hyper focused on Shopify and looking at their Shopify reports. But also, they've pulled a Shopify loan or they have an SBA loan. And there's other hidden things within that core report and the importance of highlighting that larger picture with them.
Yeah. Yeah, I agree, right? No, it's just having an understanding of a full scope of what's going on in all aspects of your business when you're spending money, especially when you're spending money, right?
Yeah.
And you need to know where you're spending money, and you need to be sure to quantify that, which is why bookkeeping, just even a bookkeeping software is super important, using your QuickBooks. But having a CFO on board to help you analyze that data and help you optimize where you can, like, reduce your spending or increase your revenue or your cash flow, it helps out a ton.
And people always ask, how do I know if I need a CFO? I'm too small for a CFO. You get all those conversations. And to me, the most valuable thing that you can do is just bring in a CFO for a really short-term engagement. Get everything set up right from the onset and then move back to the bookkeeper role. That's something that I really try to bring to clients is this idea of almost like a CFO sprint where let's just go in, we're going to spend a few weeks, we're going to make sure QuickBooks is set up, we're going to make sure that the reporting is spitting out helpful information, and then we're going to collaboratively work with the bookkeeper so that we're all set up for success going forward. And that could be the biggest point of value for a CFO early on until there's complexity of maybe wanting to sell, maybe wanting to raise money, maybe wanting to introduce a little more complexity into the strategy and the business model.
Yeah, yeah, makes sense, makes sense. So hiring a CFO when you need one, and if you like in the meantime, if it's not within budget, just having a bookkeeper on staff or just doing basic bookkeeping, and also if you are preparing for an exit, if that is what you're looking to do, then of course bring that CFO at that point. So I know that you look. I remember I said at the beginning, 10x increase on the value of a company by just doing the things that you do. I want to understand more about that. Like, what financial indicators are you able to let me know when someone might fail during due diligence process and they might run into a roadblock? What are the red flags that you're seeing that scares
It's
buyers away?
interesting. I've seen it again, kind of same problem from two different angles. You have problem number one. which there's solutions for both. So I'll speak to that too. But problem number one is when you have an owner who's running a lot of personal expenses through the business for the sake of tax efficiency, strategy, whatever it may be. And that's not necessarily representative of the operations of the business as a potential buyer may look at the business. And so to have that ability to strip out some of those expenses and get a more realistic view. On the other side of it, I've had clients that are bootstrapping and have the ability not to pay themselves in the short term and to really bootstrap the business. And the challenge with that side of it is someone coming in and actually needing to hire a real CEO to run it, to hire a real thing. So there's actually the absence of costs. And that's where it becomes really important to have a good set of books in order so that you're set up to appropriately communicate it, think about business lines, business units, to think about strategy and all those components. And that's what's going to ultimately give you that opportunity to 10x if you're looking to grow, or perhaps you're looking for a 10x multiple and sell the company. And those are the things that you need to understand best so that you can communicate value to that buyer.
Got it. Got it. Look, I want to transition here. I know we're coming to an end. We love to always ask every guest that we have on the podcast that's around high. We have a data set that we're building around high level operators and decision makers. So we ask every guest these same questions. Now I'm gonna go through these pretty quickly. I'll
Okay,
ask you a question. You spit out the first thing that comes to mind. You ready?
great.
Okay, cool. Question one. So when you're making a high stakes decision, what's the first principle or framework that you rely on?
Mm, For me, my intuition, and for the client, me understanding the client and what their true motivation is so that I can ensure that their motivation is aligned with the decision making.
Got it. Intuition. Trust your gut.
It's been tons of experience in almost 20 years and countless businesses that I've seen.
Got it. Okay. What's the most common bottleneck that you're seeing consistently that prevents companies from being able to scale effectively?
The biggest bottleneck is being too in love with their company as it stands, and the unwillingness or inability to see how tweaks can happen and perhaps an augmentation of the business or the product in some way that really creates high profitability, and the willingness to kind of check the ego and move through that exercise and to see the business as separate from you.
Yeah, yeah. I just had a meeting like today, and just the question they asked me was when someone is a bit older, they're stuck in their ways, and they're not ready to really start utilizing any sort of automations in the company. How do you help them overcome that? I said, well, one, I stay away from all the AI jargon. The AI
Yes.
jargon isn't what you focus on. But like, can we focus on the solution to the problem? And if someone is a good operator and good CEO, then they'll make the best decision for the company. At the end of the day, a decision has to be made, whether they go autonomous or they go and hire staff. Again, it just goes back to bottom line. What can they afford to do?
I
Right?
agree. And to expand upon that, a CEO's strength is really in that ability to know what you need as a CEO to be reported to you, delivered to you. And I think to release a little bit from how that's coming to you.
Right.
And that as you're building a team of professionals around you, they have their own expertise and they have their own efficiency in how they work. And to allow that to happen, be it automation or whatever it may be.
Yeah. Yeah. Okay. So next question here. When you're evaluating leadership teams, when you have to hire, what's one signal that you rely on, or you that immediately tells you that someone's an A plus talent?
So the non A plus talent, the very early indicator is their ability to keep a meeting time. You know, when you're kind of in the early days of selling, how well are they communicating? And if I'm chasing too much, I back off and I assume that that's going to lead to a poor client. And the A plus clients are the ones who really engage and in intimidation of financial conversations are willing to be in it and ask questions and move through those conversations in however intimidating they may be.
Wow. Wow. And so the way that you evaluate a client is almost the same way that you would evaluate a team member, someone that you would bring onto the team.
I would
The
say so.
punctuality.
Yeah. You know, at the end of the day, all of it is all relationship building. And in particular with
Yeah.
finance, you're getting in so deep with people in their business and their money and often their life as well. And there's got to be a little bit of mutual love and respect, and ability to talk and communicate. And if I feel like I'm chasing someone, it's the early indicator of me of how hard would that then be to have a more direct conversation and their willingness to receive that.
Agreed. Agreed. All right, I have only two more questions for you here, Josh. So, if you had to double the value of a company in 12 months, where would you focus?
Oh, I would focus on I would focus on how to drive more revenue and growth, because if one assumes that you've optimized how you're operating and what your core team is, it's that ability to grow. I mean, we're going back to that 10x comment, and it's do you want to understand those triggers of what growth is? I sat on my heels for a long time with referrals, and referrals dried up for a moment, and I realized I didn't know how to market or sell. And so that's what drives.
Yes, agreed, agreed, and I love that we keep going to, the 10X, and
Yeah.
I love 10X because I remember I read this book once, and it was, 10X is easier than 2X.
Yes.
I believe it's by Dan Sullivan, is who wrote it. But he just basically said like 2x growth is still pretty linear. Like if you're looking at a chart, 2x growth is just growing over time in a linear fashion, but 10x growth is not. And in fact, you by growing by 10x, it forces you to stop everything that you're doing that's forcing you to grow by 2x and change it.
Yes. I'll add to that. I was once asked a question, and let's just say, for example, to be making $400,000 a year in revenue. I had a coach ask me at one point, what would it feel like to make 10 million a month? And the jarring of that question, kind of in a different way, the 10x thing made me think linear with my existing business plan, but it was that making 10 million a month was so jarring and so dramatically different that it opened up ideas of how I could augment the business. And I think that's really the value of those conversations, the 10x or whatever it may be.
Yeah, and like asking yourself, how can we grow exponentially? What do we have to do differently? How do you have to be different as a founder? Great. Okay, last question here. What mistake are you seeing founders make over and over again that cost them the most?
It's the cliche, I think, of starting a business and pricing yourself too low. It never pays off. It turns into referrals where people communicate the wrong amount. You start to build a business and then you're at capacity and you're not making the money you want to make, and you're not doing anyone a favor, because if you're not making the money that you need to make for a healthy business, then you can't deliver on that business.
Agreed. Agreed. Yes, Josh, thank you. We've had an amazing conversation about what people or business owners or founders can do to best position themselves for exit, but also just take better care of their books and then live a healthier financial life in their business. Is there any last words before we wrap up today?
The words that I love to always part on are, we all know professionals in our network, be it finance, legal, marketing. Always just go ask questions. Don't feel like you don't have the money to engage or whatever it may be, but go ask questions. Go buy a book. Go educate yourself.
Love it, Josh. And where can they find you?
CFO-minded.com, or wrote a book called Numbers Scare Me and Other Excuses, which you can find on Amazon, or go to numberscareme.com.
Thank you so much. We'll go ahead and paste all the links below. Please check out Josh. Thank you for watching or listening today.